What's up, guys? Welcome back. Before I even knew about YouTube, I used to use an investing strategy that made me a bunch of passive income weekly. Now that I'm onto YouTube, I see that it gets a lot of flack and people just don't like it for whatever reason. And what that is selling cash covered puts and covered calls as well. Now, because there's a lot going on with options and things like that, I'm just going to break them down into two different videos. This one is just going to be a cash covered put. I'm actually going to make a trade right now for you guys to see live. And I think right now the way it's looking is I'm going to make between $25 and $30 for doing absolutely nothing. As always, guys, there are risks associated. I'm going to talk about each one of those risks, and then you can decide for you if it's something that you might want to do more research on and then possibly do. So I think the best thing to do is just to dive down into Robinhood, look at exactly what's going on. I know it can seem confusing. You know, an options chain can just look totally daunting. I'm going to take it one thing at a time. I promise you guys will completely understand it. And you'll kind of be thinking to yourself at the end of this video, wow, this seems too good to be true. And for a lot of people, it is, but for me, it's not too good to be true. Okay, so here we are in my Robinhood right now. It's $47.71 with a little bit of buying power. Now, the one downside, I'm going to right off the bat, is you need to have cash to cover the trade that you're about to make. And they call it collateral. This is very different than selling a naked put, where if you get assigned, you are going to have to go into margin to pay that back or put money in. In Robinhood, you have to have the money in to do it. So you have that cash collateral, and that is the one downside because you do need a good amount of cash to even set this up. So if you have a smaller account, it's a little tough. For me, what I've done is I've looked and I've ranked all of my stocks from lowest to the most expensive, and you'll see why that's important because I have a relatively small account and I can really only do this cash covered put with a few of the stocks in my portfolio. So if we want to make a cash covered put, we are going to choose a stock that we want to do this with. Now, first disclaimer, this needs to be a stock that you want to own. This is going to help make it a win-win because you're either going to just get some passive income that we're going to call premium, which I'll show you in 1 second, or we're going to get premium and 100 shares of this particular stock. So it's a win-win. If you're chasing premiums, guys, that's just gambling. Don't do that, okay? Pick the stocks that you want. I eventually want 100 shares of Wells Fargo in my portfolio. So I have no problem making this trade because if it gets assigned and I need to buy it, that's okay. I want to buy it. And because of the type of trade this is, I get to pick the price at which I buy it. It's essentially like picking a limit trade, but you also get the premium from the buyer as well. So let's look at that. I'm going to click Wells Fargo and we're going to go right into this. So we see Wells Fargo is actually shooting up a little bit today. And for shooting up, guys, that's not really that big. It's pretty much ranged right in this $27 to $28, dropped down to $26.30. Currently right now, my cost basis is $27.27. I only have 6 shares of it. I'm potentially going to be buying 100 shares more. But I use my average cost basis as kind of like a benchmark of where I might want to make my trade. Because when I make the trade, I essentially want to lower that basis, right? I don't want to pay necessarily more than my average. If I can, I want to lower the average cost of each one of my shares. I'm going to come over here and I'm going to say trade Wells Fargo options. Now this is where things can get really confusing looking, guys. This right here is just called an options chain, and an option, what it is, it's an agreement between up here the buyer and the seller, and there's risks and rewards for both the buyer and the seller. In my opinion, you need to know a lot more, and it's a lot more information to understand to be a buyer. I'm not comfortable being a buyer yet. I know people are very, very profitable. For me personally, I'm just not that ready to be a buyer yet because more things need to happen that are outside of your control. But the reward is much greater. What we're going to be doing is selling an option. Another way to say that is writing an option. You might hear somebody say, oh, I wrote that option. Writing and selling are going to be the same. So we are going to sell. Now there's 2 more options. We have a call or a put. This video, we're going to talk about puts. And then depending on what happens with this trade, I'll do a cash covered call as soon as I get assigned to my cash covered put. Once I'm set to selling and put, you are going to see the share price right here. And this is where vocabulary starts to come in. At the money, in the money, out of the money, things like that. Don't get yourself too concerned. Just understand where the share price is currently. Right now it's trading at $27.93. Over here on the left, we see the strike price. Now the strike price is essentially when that share gets to this price, this option can be exercised by the buyer. Now, we look over here, expiration is going to affect a couple different things. It does not affect the strike price. Strike price is going to stay the same, but what it does, it affects this over here. And this is a premium that the buyer puts up to make this trade with you. And depending on the expiration date, the further out you go, the higher the premiums are going to be. So for example, it's 44 cents per share right now. If I make the expiration date, say June 12th, it jumps up to 83 cents. So almost doubled for going one more week. But now an option contract is 100 shares. So we take this 85 cents and we multiply it by 100 because it's 85 cents per share. So if we're doing absolutely nothing, I am at least going to get 85 cents if I make this trade right now with an expiration date of June 12th. I personally like to do this weekly, so I'm going to set it for the next expiration date, which is June 5th. Now, the further away from the current share price you get, the premium goes down because the likelihood of that share price dropping down to these strike prices is lower. So there's not as many buyers out there that are willing to put up a premium for it to go that low. As we saw just a second ago, it's pretty much been bouncing between like 26.50 and 28. So the chances of it going to 25 are really, really low. So it has a really, really low premium of just $5. And people always ask this, and it's a really good question about taxes, guys. Premiums are taxed according to a short-term capital gains tax. So essentially your regular income tax. So you will be taxed on these premiums, but these premiums are yours to keep regardless of whether the option is executed or not. So once again, what affects this premium? Well, what affects it is the strike price and how far away we are from the actual share price and also the expiration date. And you might be thinking to yourself, well, wouldn't I want to go way down here so maybe it doesn't get executed? Yeah, some people want to do that. But like I said, I want to own the stock. I almost want it to be exercised. You guys have to go into this trade expecting assignment and hoping for it to go worthless. And by worthless, meaning if this share price does not drop to the strike price that I choose by the expiration date, then it'll just be worthless. You get to keep that premium and all of your collateral gets returned to you to repeat over and over again. So I'm going to make this trade right now, and then I'm going to talk about all the possible outcomes and possible dangers that come with this. I showed you just a second ago. Right now, my basis is $27.27 per share. That is less than $27.50, but more than $27. So I have two choices. I can raise up my cost basis a little bit, 25 cents, and I can receive $17 more, or I can lower my cost basis and take $30. That's the choice that I'm currently going to do. So what I'm going to do is I'm going to click plus. So right now I am selling a $27 strike price put for an expiration of June 5th. My total credit is going to be 30 cents per share. Now, as I just said, one contract is 100 shares. So I would just type in 1. There is the credit that I am going to receive, which also is going to help me lower my cost basis. Now, as you see, guys, this cost me $2,700 of collateral to put up to make this options trade. If I didn't have $2,700, I could not make the trade. And that goes along with the strike price. If I would have chose this strike price, I would need $2,750. So like I said, you do have to save up some money to be able to make this. But I just made $30, which is in 1 week, which is more than the dividend of Wells would have paid me for the entire year. So here's where we can start to increase our income every single week. This expiration day is this Friday. If it doesn't get assigned, I'm going to do the same thing next week and next week until it gets assigned, and then I'll start selling covered calls on it, which would be that video when it happens. But you can essentially make $30 every single week, and it actually just jumped to 31. I'm going to press submit. Now it will go out for a bit. It will be good for a day, just like placing any order. I'll press done. So if we jump into Wells Fargo now, we will see this put order right here. It has been placed. Once it goes through, I will be credited with $32 now, $32. and that will be mine to keep forever. So here are the scenarios. Here's the possible scenarios and the risks that come along with this. So scenario one is that Wells Fargo does not drop to $27 by the 5th. If that happens, I keep my premium, I get my collateral back, and I repeat. That's called the contract going worthless. And for a lot of people that do this on a regular basis, that's the ideal scenario, right? They get to keep their collateral, they get to keep the premiums, and they get to do it again, and they don't have to purchase 100 shares. The second scenario is that it is at $27 or below on the 5th, and then I will be required to buy 100 shares of Wells Fargo. And that's okay with me because, like I said, I want to hold this stock. It's a stock that I don't mind having 100 shares of, so it's not that big of a deal. So I'd get 100 shares plus the premium. Then we're going to use those 100 shares and we're going to do something called covered calls, which would be another video when this eventually gets assigned. Now, the downside, okay? People say, well, what happens if Wells Fargo tanks and it goes to 0? Yeah, that could happen. Likelihood, not so much. But here's essentially the pill that you might have to swallow. If it goes to 0, they go bankrupt, they're done, and the 5th comes, I still have to buy 100 shares for $2,700. So the dangers are I might have to buy a company that's worth 0 for $2,700. Not very likely, but that is a major risk. Let's be more realistic. Let's say instead of 27, it drops to 25. Well, I just now had to buy a $25 share for 27. So I just lost $2 essentially per share. So that's a $200 immediate loss for me. That happens. And how do I mitigate that loss? Well, like I said, these are stocks that I won't mind buying and holding for a long time. If it dives to 25, I'll just hold on to it. The price will eventually start to climb back up one day. It'll get back to 27 and I'll be fine. The other thing I could do is I can sell covered calls, collect premiums, lower my basis, and get back to even that way. So the only real big problem if it dives is if you didn't want to hold on to the stock. Now you're stuck with this $25 stock that you paid $27 for. That might suck, right? But for me, I don't care. I'll hold on to it for a year, 2 years. I don't care. Eventually, it's going to get back up to 27. Now, if something monumental happens and it went to like $5, it's going to take a really, really long time. Yeah, sometimes you lose in the stock market, guys. Those are the risks that we take for these rewards. And other people say, you put up $2,700 to get $32, $33 back. It's not like putting it up. I was going to have to buy those shares anyway. So yes, did I put up 27 or have to have 27 in collateral to make $33? Yes, but at the end of the day, that $2,700 is still mine, or I'm going to have 100 shares worth of stock. So it's not like I'm losing it to get $33. So guys, even just now recording that video, people's like, how long does it take to place that order? In the time I took to record this video, it's already been placed. If we go back out to my portfolio, it shows all your options at the top above your stocks. So essentially, I won't even look at this. It's not going to be a big deal until the 5th. Once we get to the 5th, if it executes, then I'll make a video about cash covered calls. If not, I'll let you know exactly what happens. But as right now, I got $32 placed in my account, which is pretty much one free share. So I got one free share of it. Awesome news. So I really only have to buy 99 because I got one for free. Options can seem really confusing, guys. And just because they might seem confusing doesn't make them any more dangerous or risky as buying individual stocks as it is. It's not the options that are dangerous. It's a lack of education. So please remember, before you do any of this stuff, make sure you're educated and confident of what you're doing. Know the risks and the rewards. Do not, under any circumstances, ever be greedy and do things with inside your means. Just like the old phrase, things are not scary, people are scared. Options are not dangerous. The lack of education and dealing with them is what's dangerous. Guys, if you learned something from this video, please, I beg you, give the video a thumbs up. It lets YouTube know that this was valuable content and other people might want to watch it. For more videos like this, if you are new to the channel, consider subscribing. And until I see you on the next one, guys, stay positive, work really, really hard, always be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.